forward in your trading journey. So, stick around, because every topic we explore today could be the key to unlocking consistent success in the market. And hey, if you find this video helpful, don't forget to like, share, and subscribe for more insights to sharpen your trading psychology and strategies. Let's get started. Accepting uncertainty. One of the biggest mental shifts a trader must make is accepting that the market is inherently uncertain. Mark Douglas explains that no amount of technical analysis or fundamental research can eliminate the unpredictability of price movements. The market isn't something you can control. There are too many variables at play, many of which are invisible or unpredictable. Trying to predict every outcome only leads to frustration and poor decision-making. Douglas emphasizes that traders often struggle because they want certainty before placing a trade. This need for control creates fear of being wrong, fear of losing money, and fear of missing out. When a trader becomes emotionally attached to predicting the market, it leads to hesitation, overanalysis, and impulsive decisions. This emotional turmoil can cause them to deviate from their trading plan or hold on to losing trades, hoping the market will turn in their favor. Successful traders, however, adopt a completely different mindset. They understand that every trade carries a degree of randomness. No single trade defines their success. Instead of focusing on being right, they focus on following a process rooted in probabilities. For them, a winning edge is not about predicting individual outcomes. It's about executing trades consistently and letting the law of large numbers play out over time. Douglas argues that the market doesn't owe anyone a predictable pattern. By accepting this reality, you release yourself from emotional baggage. You stop tying your self-worth to the outcome of a trade and start approaching the market with a calm, objective mindset. This shift allows you to follow your plan without hesitation, knowing that losses are a natural part of the process and that the next trade always presents a new opportunity. Thinking in probabilities is one of the most crucial mental shifts a trader can make. Mark Douglas explains that the market is an environment where anything can happen, at any time, for any reason. No matter how much experience or knowledge you have, you can never predict the future with absolute certainty. This is why successful traders don't think in terms of being right or wrong. Instead, they view each trade as part of a larger probability game. Every trade you place has an uncertain outcome, but over a series of trades, patterns emerge. If your trading strategy has an edge, a statistical advantage, then over a large enough sample size, that edge will play out in your favor. This is the same principle that casinos rely on. In any given spin of the roulette wheel, the outcome is unpredictable. But over thousands of spins, the casino knows its statistical edge will generate profits. Traders who think in probabilities adopt a similar mindset. They don't focus on whether any single trade wins or loses. They focus on consistently following their system because they trust the long-term results. Mark Douglas points out that many traders struggle because they become emotionally attached to individual trades. When you believe you can predict the outcome, every trade feels personal. Winning trades boost your confidence, while losses feel like personal failures. This emotional cycle leads to hesitation, second-guessing, and impulsive decisions, making it difficult to stick to a plan. But when you shift to a probability-based mindset, that emotional attachment weakens. You no longer need to know what will happen next because you understand that a single trade is just one event in a much larger picture. Thinking in probabilities also helps you accept losses as a natural part of the process. Even with a profitable strategy, losing trades are inevitable. But when you view losses as statistical events rather than personal failures, they lose their emotional impact. Instead of fearing a loss, you accept it as the cost of doing business. This mindset allows you to stay calm and focused, making it easier to execute trades without hesitation. Another key point Mark Douglas emphasizes is that probabilities require consistency. For an edge to work, you must trade it consistently over time. If you pick and choose which trades to take based on how you feel, you disrupt the statistical balance and lose the benefit of your edge. Successful traders trust their system and execute it with discipline, knowing that over time, the probabilities will work in their favor. This mental shift reduces emotional stress, improves decision-making, and allows you to approach the market with confidence and clarity. Overcoming the fear of loss is one of the most important mental barriers every trader must break through. Mark Douglas explains that this fear is rooted in how people are conditioned to avoid failure. From a young age, mistakes are often punished and success is rewarded. This mindset carries over to trading, where losses feel like personal failures. But in reality, losses are an unavoidable part of the process. No strategy, no matter how effective, can guarantee a win every time. Accepting this truth is the first step toward freeing yourself from the emotional grip of fear. Fear of loss creates a destructive cycle. When you're afraid to lose, your mind goes into a defensive state. This can cause you to hesitate when you should act or exit trades too early to avoid potential losses. On the other hand, fear can also lead to holding losing trades longer than you should, hoping the market will turn in your favor. In both cases, fear clouds your judgment and pushes you away from rational, disciplined decision-making. Mark Douglas emphasizes that to overcome this fear, you must reframe how you see losses. Instead of viewing them as failures, treat them as a cost of doing business. Just like a shopkeeper accepts the cost of inventory, traders must accept that losses are part of the game. Each trade is just one event in a larger series. No single loss defines your ability as a trader. What truly matters is how well you follow your plan over time. One practical way to reduce fear is by fully accepting risk before you enter a trade. Many traders place trades hoping not to lose, but that mindset only fuels anxiety. Instead, Douglas suggests defining the risk clearly. Know how much you're willing to lose and be comfortable with that amount. Once the trade is live, the outcome is out of your control. By accepting the risk up front, you detach emotionally from the result, allowing you to focus on executing your strategy. Another key point Douglas highlights is the importance of building trust in your edge. Fear often arises from uncertainty, when you're not sure your strategy works or when you deviate from your plan. By sticking to a proven system and gathering data over time, you build confidence in your process. This confidence reduces the emotional impact of losses because you know they're temporary and expected within the larger framework of probabilities. It's
Mic checker, 1 2 1 2. How y'all doing? Good morning, good afternoon, good evening. Wherever you trading from, let's make it a good trade. All right, we're gonna get right off into it. You're into the Asian session. Right now, we're looking directly at the S&P 500 micro. Right? Take it slow, trade it low. As always, do your own research. This is not financial advice. This is what I do and how I do it. And the biggest contradiction is, it ain't none of your damn business. All right, y'all. Y'all know what it is. I'm about to go touch some grass. We're going to get in here. We're going to be mainly in the Discord tonight. I just want to do an open as always on YouTube. Get that content over there. Whether it's just me and my own like. But we at it. All right, y'all. Go and touch some grass.
Yeah.
Hello there. I want to really congratulate you if you made it to the Las Vegas Trade Mentors Conference. This is a presentation I gave there. And what's really interesting about this is I was actually on a cruise ship for an entire month. And what happened was that I met a very interesting individual who actually is a professional futures trader, trades a 2 million sterling account, makes about 35,000 sterling per month, about $45,000 per month with the income strategy that I'm going to show you. Now, after I give the presentation, one of the people at the Trade Mentors Conference made the comment that she felt that this was that I was portraying this as a conservative future strategy. I want to get this clear right now. There is no such thing as a conservative futures or forex strategy. This is also this is an aggressive strategy. It's particularly aggressive because you're selling option premium. This is very advanced. This is not for beginners, and it's not for the squeamish. And you really, really have to have your game on. You have to understand a lot about the market. So this is just simply another reason why this video is only available for people who attended the Trade Mentors Conference in Las Vegas. And it does become available well after the first year in Trade Mentors, and I will not supply this even on request for anybody but people that came to the conference in Las Vegas. But the main thing is remember, when you're in the futures and forex markets, you're trying to get obscene profits very, very fast. Obscene profits very, very fast. This is not a conservative strategy. It's an advanced strategy. It's a very advanced option strategy. So here's how it goes. The principle here is to sell calls on the weakest index with a large liquid option market, and sell puts on the strongest index with large liquid option market as well. Now the thing is there's lots of stock markets around the world. Internationally, the three primary indices are the US Stock Exchange and the London Stock Exchange. Now there's a couple of other key stock exchanges out there. One is right now an exchange that has become very, very strong, and actually it looks like it may become stronger than the Japanese stock index, is the Hang Seng Index. And what it is, it's like the 30 largest stocks on the Hong, I think it's 30, the largest companies on the Hong Kong Stock Exchange. The reason it's become so strong and so powerful is because of the enormous success of the Chinese economic phenomenon. So what it does is that it gives you a very large liquid market, liquid option market that you can sell premium into. The calls are sold on the FTSE. The FTSE is the 100 largest stocks traded on the London Stock Exchange. And the idea here is to write calls. You're going to sell calls on the FTSE that expire month after month. Thing is if you go out and buy an option, you have to pay money. Money comes out of your account. If you sell options, then money comes back into your account. So the trick here is you're selling, this is also called writing, calls on the FTSE that expire month after month. Now, the FTSE rarely leads a large rise. It gets forced up against its will if all the markets rise. This is really useful because if the S&P 500 starts to make a really quick rise, then you'll see it, and that big rise will translate into the FTSE after a number of days after the large rise in the S&P 500, or even various hours. What it does though is it gives you time to recognize that if there's a really massive move in the U.S. markets, then you can watch the U.S. markets, and it gives you time before you have to deal with your calls. Okay, so the trick here is that with the Hong Kong index, the HSI, you prefer put rights. Now you're buying an index of Sean, who was showing me the strategy, was talking about it if the index is at or equal to 20,000, he sees a big upside versus a smallish downside. These were the numbers at the time when we were talking about this, so don't put too much evidence into 20,000. I'm trying to get you to get the gist of this strategy, because Open eCry still has to make the Hong Kong, the HSI futures available before you can actually trade the strategy. So pester Todd over at Gecko Financial Services and LAN to make sure that the Open eCry is induced to get their act together and get the HSI futures trading so you can do the strategy. Now, the idea is that when the S&P 500 is bullish, what you're going to be doing is you're going to be selling puts. Puts become worth more money when the stock market goes down. So if you want to make money with long puts, then you do it when the market is bearish. If you're selling, it's just the opposite. If you want to collect that premium and you want the options to expire worthless, then you sell puts into bullish markets. And so because of that, you sell puts on the Hong Kong HSI index when the S&P is bullish. When the S&P is bearish or flat, then you sell nearby calls on the FTSE on the London Stock Exchange. So this is the whole trick behind the strategy. Basically, this is the whole strategy right here. I can stop right here and you could actually do this strategy. Even though it's advanced, it's actually quite simple. So if the S&P is bearish, again, you can use all of the technical indicators on the track and trade platform to judge when the S&P is bearish, understanding the major and minor trend, as I explained in the Stanley Kroll presentation, or bullish, then again, bullish, you go towards Hong Kong, bearish, you go towards the London FTSE. Okay, so here's the basic idea. Step one, own a position outright in equities. Vanguard 500 fund, the SPDR, the Gone Fishing portfolio, or you're trading momentum stocks, IPO value like Berkshire Hathaway, insider stocks or takeover stocks. Okay, in my stock investing course over at investmentu.com, I teach all of this stuff about these what are so-called anomalies. These are called anomalies where investors get very high returns investing in specific individual stocks such as momentum, IPO value, insiders, or takeovers. Or a very, very good strategy in your retirement portfolio is the Gone Fishing portfolio of index mutual funds or ETFs. Or if you're in you say you're looking at your 401k, then you're having large amounts of stock positions in the Vanguard 500 or the SPDR. The idea is that when you're selling these puts and calls, it's not completely naked. You actually have some net worth, so that you're not nervous and stressed out about doing the strategy. And so it's somewhat in that sense kind of like a covered call strategy or selling puts, which Karim teaches over at Oxford Club. This is much, much more elegant and advanced than anything Karim is teaching over at the Oxford Club, because again, you are using equity index futures to achieve this strategy. Okay, now the FTSE call right is interesting. With the FTSE 100 index futures responds more slowly to the upside than S&P 500. So you can use the S&P 500 to forecast the direction that's going to lead the FTSE. So if you get this massive, super fast increase in this S&P 500, then you're going to want to step in and cover your long positions by calendarization, which I'll explain here in a bit. So the second step in this strategy, the first step is to own, have stock market positions that you own outright without any kind of leverage. And the second step is you sell the FTSE 100 nearby calls in a bearish S&P 500 stock market. So when the S&P 500 stock market is going down, you're selling the nearby FTSE calls. Here's a good example. See, the S&P 500 was bearish, you would have been selling the FTSE calls in here. S&P 500 is bullish, you'd be selling the Hang Seng puts here, and any positions that you had here, if they started going against you, you started losing on your premium, your short calls on the FTSE, you would cover them with calendarization. Okay, so the FTSE 100, a good example, from March to October, the S&P 500 rose 54%, but the FTSE, that should be an E, the FTSE 100 only rose 30% over the same period. So I'm just illustrating how the FTSE is kind of like a flat tire compared to the S&P 500. It just doesn't rise as fast as the S&P 500 does. So this is the end of video 1 for this workshop. Go on to video 2. Okay, why is the FTSE lag the S&P 500? Well, let me go over the basic reasons that that's actually true. And number one, international stock returns are about 1/2 of U.S. returns historically. So U.S. stock investors tend to make more money, get double the return of investors over in overseas stock markets. I go into a lot of detail in my course at Investment U, where I teach the specifics of individual stock investing about international stocks and international markets. So this is kind of just a rough overview, but this is all you really need to know to trade the international equity futures. Now what this means is that the FTSE responds to the upside more slowly. What it does is it makes it more likely that the call will expire worthless, on top of the fact that you can use the S&P 500 to see what's coming down the train tracks in terms of what you're holding over in the FTSE. So by selling the nearby call, time decay is on your side. This makes it more likely the call will expire worthless. Options are kind of funky. They're not like stocks. Stocks have a linear relationship between price and value. Options have all sorts of weird curved relationships. Those curved relationships are incorporated in something called the Black-Scholes option pricing model. So you've got these kind of things that you're watching out with options. Number one, underlying volatility, and that's the main thing. And then the other thing is how fast does the option price respond to underlying volatility, and in large part depends on how long the option has until it's going to expire. If there's a long time till it expires, there's a lot more likelihood that it's going to end up expiring worth something. So the option responds really, really quickly to underlying price changes or underlying volatility. If there's a little bit of time left, it's really likely that it's not going to expire worth much money. So the options react less to underlying volatility in that situation. So what you're doing is the call expires worthless if the market goes under the strike price. So you're selling calls when the S&P is bearish. This gives you even more likelihood, gives you a directional bias. And of course, over at Track and Trade, we're masters at directional bias in the indices using the Track and Trade technical tools. So that's what's going on here. And so it's time decay that's really, really working on your side by selling those nearby calls, and that's a big part of the strategy. Okay, now you can use the bulls and bears system as a huge advantage. And you do this by selling the FTSE calls only after the bulls and bears system gives you a short signal. This puts a third massive factor on your side because you'll be trading with the trend. In other words, when the market's going down, you're going to be selling calls because those calls are more likely to expire worthless. When the major trend is going up, you're going to sell puts because it's more likely that your Hang Seng puts are going to expire worthless. Okay, what about protection? You remember in the Stanley Kroll videos, he and I and anybody that's good at this emphasizes it's actually really important that you keep your losses small and you protect yourself. When you sell an option, you have limited profits in the sense that you can only keep as much premium as you bring in, but you have unlimited potential loss because when the market moves, when the market moves in favor of the long option, in favor of the person that bought the option, you have to pay them for everything that they make. So you end up with unlimited losses in the exact same sense that you would be have a loss on the underlying futures contract. The payoff on a short option is, in terms of losses, is identical to the loss diagram, loss part of the payoff diagram for the underlying futures contract. So what if the market suddenly rises very quickly? This is actually a little bit of a mistake here. It's what if the market suddenly spikes? What if it suddenly rises, such that your short FTSE calls become start losing money? You have to start paying out premium to the person that bought the calls. Well, the solution is something that calls this, by the way, should say rise, and worth less premium than you brought in. Well, the solution is to calendarize. How do you do this? Well, if you're short the nearby month, let's say you're short the nearby call, all you have to do is buy the call at the same strike in the next month out. Now the losses on your call are covered by the gains. The losses on your short call, the losses on your short call. I'm gonna have to fire my secretary who made all these mistakes in these PowerPoints. I guess I should hire a secretary first so I can fire her. Long. This is your long call. Okay, long call. And the next month out. So now your losses on your nearby short call are covered by gains on the long call you buy in the next month further out. Now you can end up in a really cool situation where the market can then recover so such that your short call expires worthless, and then reverse again, so that you end up making money on your long call once you calendarize. So so by calendarizing, you're really giving yourself many more opportunities to still make profit on this position. Okay, so by converting the short call into a calendar spread, a calendar option spread, you can option spread. You may be able to sell the put if you get another bearish Bullish bear signal, and still make money as the short FTSE calls expires worthless. Again, just like I said, you can end up with price behavior afterwards where you still make, you end up double dipping on this position even after you hedged through by calendarizing the position. Okay, so if you've got, so here we go for protecting. Let's say that you were, you had sold a bunch of calls in here in the nearby month, and then the market started to really rise on the S&P 500. Okay, this, you would start to protect your calls here, and then you would switch over to selling puts on the Hang Seng, because now the market would be shifting from long-term, from a downtrend to an uptrend. So you're paying a lot of attention to the daily chart when you're doing this strategy. Okay, with the Hang Seng index put right, the third step is when the S&P turns bullish, you sell Hang Seng puts. Why? Well, the Hong Kong dollar is pegged to the US dollar, and Hong Kong interest rates are pegged to US interest rates. And again, that should say interest rates, okay? Interest rates. But option premium in the Hang Seng index is higher than it is on the S&P 500 futures. So that's great. So I mean, you can, when you sell your puts over there in the Hang Seng index, you actually bring more money in than you would in the US. Same goes for the FTSE. So that's why we love the FTSE and we love the
Mike, check. All right, guys, how y'all doing? What we're gonna do is, I see an opportunity to sell here. I am in my practice account, so I'm gonna look for the opportunity to sell here. If it does not break 294 here, 294. If it don't break 294, I'm gonna sell back down to my entry point and see what happens here. But remember, it got some room down here to take a lot of money from a couple of days ago. And then if it takes that money, it can take this money too. So we just gonna wait and see what the market really want to do today. We're gonna break down some other things. Man, you gotta be in the Discord to catch all that. We got a couple things going on, so we're just resetting for the week. If you don't know, now you do. Just me and you. All right, y'all. What's gonna happen is I'm gonna continue to do this. We'll be back here probably sometime just shy of the Euro lunchtime, and early enough to catch some pre-market action in the New York. Yeah, stay healthy, you stay safe, you stay humble. This is what I do and how I do it. And at the end of the day, the biggest contradiction is it ain't none of your business. All right, I'll catch y'all. Catch me in the Discord. That's where we about to be.